We kick off today's coverage with a quiet but telling move out of the Middle East. Saudi Arabia's Tadawul All Share Index closed down 0.40% on June 21, 2026, a modest pullback on the surface, but one that carries real signal weight when you consider the broader backdrop. U.S. markets are painting a decidedly uneven picture right now. The Nasdaq 100 is surging 2.51%, while the Dow dips 0.15%, suggesting investors are rotating selectively rather than buying the market wholesale. That kind of divergence in developed markets tends to create hesitation in emerging market positioning, and today's Tadawul move fits that pattern precisely. The Tadawul All Share Index, Saudi Arabia's primary equity benchmark and one of the largest emerging market exchanges by market value, closed lower by 0.40% on June 21, 2026. There were no major domestic earnings releases or policy announcements cited as direct catalysts for the move. Instead, the decline appears to be a product of global crosscurrents. Brent crude, which directly anchors Saudi government revenue projections and corporate earnings for the kingdom's energy giants, is trading at $80.59 per barrel today, up 0.93%. Crucially, that crude strength did not translate into equity gains, which itself tells you something important about investor sentiment toward the region right now. Here is where the analysis gets genuinely interesting. Normally, a rise in Brent crude should be a tailwind for Tadawul, given that energy and petrochemical companies are the index's dominant constituents. The fact that equities fell anyway suggests the market is discounting something beyond near-term oil prices, possibly concerns about Saudi Arabia's Vision 2030 capital expenditure pipeline, margin compression in the downstream sector, or shifting rate expectations. The 10-year U.S. Treasury yield sits at 4.45% today, and that level continues to exert gravitational pull on global capital flows, drawing money toward dollar-denominated assets and away from frontier and emerging market equity risk. For U.S.-based traders, the transmission mechanism runs through several key tickers. The energy sector, ETF, and OH, which tracks oil services companies, both carry indirect exposure to Saudi market health through global energy sentiment and capex cycles. EM, the broad emerging markets ETF, captures the signal most directly since Saudi Arabia holds meaningful index weight in the MSCI Smart Share Global Framework. Brent crude at 80.59, measured by conjoint equals F, is the fulcrum. If it fails to hold that level, Saudi fiscal calculations tighten, Vision 2030 spending could slow, and the negative feedback loop into regional bank lending and petrochemical margins deepens. U.S. risk appetite remains relatively healthy for now, providing a cushion. The most important level to track is Brent crude at 80.59. That is the current anchor for Saudi fiscal health, and a sustained break below it would meaningfully change the calculus for Tadawul's near-term trajectory. On the macro side, the 10-year Treasury yield at 4.45% is critical because it sets the opportunity cost for capital that could otherwise flow into GCC equity markets. Watch for any shift in Fed communication or U.S. inflation data that moves that yield materially. Additionally, monitor the U.S. dollar index. A stronger dollar typically pressures dollar-pegged GCC currencies on a relative basis and can dampen foreign portfolio inflows into Saudi equities. The 0.40% decline in the Tadawul All Share is not a crisis event. It will not materially move broad U.S. equity markets or derail the Nasdaq's 2.51% rally. But the disconnect between rising Brent crude and falling Saudi equities is a yellow flag for anyone with exposure to the energy sector, OIH, or EM, because it suggests valuation or structural concerns are overriding what should be a commodity tailwind. Traders should treat Brent at 80.59 as a critical support line and watch for follow-through weakness in Tadawul early next week. That's the take on Saudi Arabia's markets today. Coming up next, another story with direct implications for how global capital is being repositioned right now. Pivoting now to the most consequential geopolitical story of the day, one that connects directly to every barrel of oil your portfolio touches. Vice President Vance is sitting across the table from Iranian officials in Switzerland, marking the first direct high-level talks between Washington and Tehran in years. The headline sounds constructive: diplomacy, de-escalation, dialogue. But the ground truth is far more alarming. Iran has simultaneously moved to close the Strait of Hormuz, the narrow choke point through which approximately 21% of all global oil transit flows. Markets are not yet pricing panic, but the risk premium is absolutely alive. Here are the confirmed facts on the ground right now. VP Vance has entered first-ever direct negotiations with Iranian counterparts in Switzerland, a diplomatic milestone that markets had initially welcomed as a path toward de-escalation. Simultaneously, Iran announced the closure of the Strait of Hormuz, the narrow choke point between the Persian Gulf and the Gulf of Oman. Brent crude has responded, climbing to $80.59 per barrel, up 0.93% on the session. WNT offshore crude holds at $76.54, essentially flat. The divergence between Brent and WNT offshore reflects the international supply shock premium being baked into seaborne crude specifically. The Strait of Hormuz is not a metaphorical choke point. It is literally the only maritime exit for crude exports from Saudi Arabia, Iraq, Kuwait, UAE, and Qatar combined. When approximately 21% of global oil transit runs through a single narrow corridor, any blockade doesn't just affect spot prices. It restructures supply chains for months. The deeper macro transmission here is inflation. Higher oil directly feeds into CPI, pressures the Fed's rate path, and compresses corporate margins across airlines, logistics, and consumer discretionary simultaneously. The 10-year Treasury yield sitting at 4.45% could reprice materially higher if an oil shock reignites inflation expectations in the coming sessions. On the winner's side, energy names are the most direct beneficiaries of a sustained supply disruption. The energy sector, the broad energy sector ETF, Chevron, and ConocoPhillips all gain pricing power as Brent pushes higher. Defense names including Lockheed Martin, RTX Raytheon, and Northrop Grumman also benefit on military escalation risk premium. On the loser's side, airlines absorb the most immediate margin damage. American Airlines and Delta Airlines Delta are acutely exposed to jet fuel cost spikes. Broader cyclicals and consumer discretionary names face headwinds if elevated oil feeds into persistent inflation. Gold at $4,172.90, already elevated, becomes a direct safe haven beneficiary if tensions deepen further. There are 4 specific levels every macro trader needs on their screen right now. First, Brent crude at $80.59 is the line in the sand. A sustained move toward $85 signals markets believe the blockade persists. Second, the VIX at 16.40 is deceptively calm. A cross above 20 is the early warning that institutional hedging is accelerating. Third, the 10-year Treasury yield at 4.45% becomes critical. A breach above 4.60% signals the market is repricing an inflation shock, not just a geopolitical headline. Fourth, and most important, watch whether the Vance talks produce any tangible language around strait reopening. A breakthrough sends energy lower and cyclicals higher. A breakdown flips every one of these signals. The bottom line is this: markets are threading a needle between diplomatic optimism and a very real physical supply disruption that has no historical precedent in the current macro environment. The VIX at 16.40 tells you investors are not panicking yet. But the strait closure is not a rumor, it is a fact, and 21% of global oil transit does not reroute overnight. Until Vance talks produce explicit, verifiable language on strait reopening, the asymmetric trade is long the energy sector, long conjoint equals F Brent, long gold, and underweight airlines and cyclicals. Those are the 2 stories that matter most today. Full breakdown is right here. If this kind of deep dive analysis helps you trade smarter, hit subscribe and turn on the notification bell so you never miss a daily market breakdown. Every session, we track the stories that actually move your portfolio.